Welcome to the Playing FTSE show. Paul's not here this week, and I'm not saying this has anything to do with it. But after his comments on esports last week, Steve and I will be staying away from the North Korea jokes this time. But I'm here, I'm Steve W, and Steve D is with me as well. How are you, Steve? How's your week been?
Not too bad, Steve, to be honest. It's been a little bit sort of red in the markets, I think. But it's picked up a little bit today. I'm just looking at my portfolio now. It's up about 0.2%, which is nice because it was down about 1.5% on open. There was everything seemed to take a little fall and then it's recovered. In terms of what I've been doing, I've been buying a little bit of Alstom, which is a train rolling stock company that we covered a couple of weeks ago. I've been trimming here and there, taking a little bit of risk off the table. And I've also got to tell you, Steve, that my Tesla, my Model 3, has developed a brand new feature to go with exploding paintwork and crunching suspension. Now, every time you open a door in the car, the alarm goes off, which is one of, I must admit, my neighbours are absolutely enamoured with this feature when I get into my car to go to work at 20 to 8 in the morning. How's your week been, Steve?
Wow, what a week that's been, huh? So starting with markets, I guess, I've been looking at a thing called the CNN Fear and Greed Index. If you type this into Google, what you'll see in front of you when you get there is a picture of what looks like a kind of analog dial. And it's not an analog dial, obviously. It's a kind of digital thing, and it's not even a real physical object. But what it attempts to do is measure market sentiment, basically. And it picks up on things like momentum and put-call ratios and volatility and stock market breadth and stock market strength and so on and so forth. All the kinds of things that traders like that I don't think either of us really uses in our decision making particularly, and I'll be honest, in some of these cases I'm not actually sure what it means, but it's a pretty good way of measuring sentiment, so whether the market's looking fearful or whether the market's looking greedy. And I'm not saying I would use that as a way of saying buy stocks now or don't buy stocks now, but it's good to kind of have in mind here. And I was looking for the first time this week the fear and greedometer, as I'm going to call it for the moment, just tipped over onto the greed side, just briefly. Just got itself above 50. It's been in fear or extreme fear, the two kind of left-hand sides of the dial, for quite a while now. And I sort of felt vindicated by this a little bit. I won't tease what's coming particularly, but I'd been thinking that this is a market that looks to me increasingly like the market of a year or a year and a half ago, rather than a sort of a month and a half ago. Stuff appears to be kind of running up quite well. The underlying economy and the economic situation, to me, doesn't seem to be improving terribly. There's talk that it might along the way, but it does look like stocks are getting excited, and I've been finding buying opportunities harder and harder to come by, especially after this kind of earnings call. So, Steve, you and I had said for a while, you've got new money. It's not the hardest thing in the world to just find Amazon or Disney at these prices. Amazon and Disney have both shot up following their last earnings, and now it is a slightly harder proposition. It's probably not impossible, to be honest, but to just find one of those two. But this makes me... I have some sympathy here with your kind of risk-off instinct here. It feels to me like the time when I was buying quote-unquote value-y things rather than quote-unquote growthy things. It doesn't look like this is the kind of golden moment to get into stocks that everyone knows are great and are kind of beaten down because the market in general is falling right now. So I've been thinking about that a fair bit this week.
Yeah, I think we've obviously been sharing the same thought. It's been a busy week. It's trying to take me away from the markets, but it's been hard to ignore. Your companies like Mercado Libre that have run up 30% already since I bought. Your Intuits have gone all the way from being 30% down to well in the green. Etsy has gone from being 40% down to being 5 or 6% in the green. These are all really, really big recoveries in a really short period of time. So I'd heavily averaged down in a lot of these stocks. So it was only too sensible that I then, remove the over allocation to them and start to just, I had a quite concentrated portfolio. I concentrated it right down to 24 positions that I was really drilling down the average prices on. And now that tension has relaxed a little bit, I've just been taking a few profits off the table and just looking at other stocks as well. So, I've been adding just a little bit into the dividend side. I've actually brought my yield up from about 1.1% to 1.7% on the overall edge of the portfolio. So it's gone up quite a bit. I'm still looking, really. I've flexed from 24 positions up to 30, and there's room to take a couple more in there, perhaps. How about you?
Yeah, nice. So I've been sitting tight just for the moment, but I'm not entirely sure that a move isn't sort of coming for me. It feels like at the start of the year, I kind of made an agreement with myself, or part of my kind of New Year's resolution was to sell less, because we sort of said in a previous show that one of the things that when we think about what we regret in our kind of stock market performance, it generally begins with selling this thing at this thing. Or not buying this thing at this thing. And generally, it's not the stuff that we bought that went horribly wrong or something like that. And not to say there hasn't been stuff that's done that, but it's that we sold stuff too soon. So I thought, I'm going to try and sit off selling a little bit. And then we suddenly got some volatility, and I had a massive reorganisation of my portfolio and told it myself it's going to be the last time I did that, basically. And the stuff I bought has generally gone up quite a bit. And the stuff that I sold has in some cases actually come down quite significantly in that big choppy period, which makes me very tempted to try and reorganise to put things back the way they were before. I sort of start to lose my sense of what's my true self and what's the kind of part of me that's just kind of hiding out for the time being, as it were. I mean, am I really the kind of person who wants to own Bank of America, or am I really the kind of person who wants to own MasterCard? So one way round, I'm a kind of value-y minded person who will buy MasterCard if it gets hammered because, that's a rare opportunity as far as I can see. On the other hand, I'm a kind of, I really want to own MasterCard, but look, I will sit in Bank of America for the time being if the market's not really giving me much by way of opportunities there. I'm sort of starting to lose my sense of self. I'm getting tempted to kind of rotate back again, I guess, which I suppose that's not a terrible or disreputable idea, but I'm still sort of thinking exactly what I want to let go of, and I'm mindful of my previous, I sold this thing. I tend to be a bit enthusiastic at turning the tank around in my case. I think
there's a problem with pigeonholing yourself as well, though, isn't it? Is that you can say to yourself, like I'm a growth investor, I will only invest in growth, and then you see these really good, really strong stocks that pay a dividend and maybe not growing quite as fast, and maybe solidly classed as dividend stocks, and you don't want to look at these opportunities and say, well, I'm a growth investor, so I can't possibly buy those. So I think it's about the mindset for me has always been about just sort of trying to put risk on when I think there's opportunity for risk and take risk off when I think, perhaps the opportunity for risk isn't quite there. So, that's what I'd be mindful of. I mean, it's been a strange month, really. Everything seems to have just been up and up. And then this week, everything just seems to have tempered slightly. So, nothing's changed as far as I'm aware in terms of the macro environment. I think all the problems that were there, a month ago are still here today. So, it's a funny old market. So I think for me, it was about taking the opportunities while I could, because I just don't sense we've hit a bottom yet. That's not a call. I don't really plan by these things. I'm just thinking, trying to react to the moment.
Yeah, I don't sense we've hit a bottom. I saw a really interesting bit of research, and I'm not saying there's anything disreputable about this, but it does strike me that on the sort of trading side of things, where you really are attempting to time stocks and sell them at highs and buy them at lows, and that's how you kind of intend to make your money rather than by owning businesses that are going to do well and produce cash for you. I saw a really interesting bit of research put out by Bank of America, who were saying that with the previous bull markets they've seen, they've only really begun when the following number is below, I think it's 20. And that is the trailing PE of the stock market plus CPI inflation levels. So at the moment, that's at about 28. The trailing PE is about 20, and CPI in the States, is about 8 or so percent. So roughly 28 or so. And they've said that, look, when you're looking at bear market rallies versus kind of new bull markets have always, without exception, begun when that number is less than 20. And I wonder whether that's got anything to do with cause or whether that's just correlation, right? I mean, it feels to me like it might also be the case that, look, they only ever began when a left-handed person made the first trade on the New York Stock Exchange or something like that. But I'm not particularly waiting for that as a sign to do stuff. I mean, clearly that's an economic factor, and the one I just said isn't. But a really fascinating insight to me on the kinds of things that traders are interested in looking at to figure these things out. I share your view for what it's worth. I don't think we're out of the woods yet. Inflation just hit double digits in the UK. I think there's sort of more trouble coming here. And As far as I can see, rate hikes aren't really working either side of the pond, at least not yet. They take some time to settle in, but I think it's going to get worse before it gets better.
Yeah, that's my sense as well at the moment. I guess I'm sort of deferring to Druckenmiller in here, who I think is arguably, the macro expert on this kind of subject, and he's quoted as saying only a month or so ago that inflation has never ever come back down to 2% without the interest rate climbing higher than the level of inflation. So if that is the case, we've got a lot of rate hikes still to come. I think some of that inflation will dissipate because I think the commodity side of it has driven quite a lot of that inflation, and I think that should come down on its own. I mean, I'm seeing that in the markets that I work in. I'm seeing that the timber prices come down even prior to any of the rate hikes. So, and you can see that in iron and copper and all the other mined materials. So hopefully that will be the starting bit to get inflation down to maybe 4 or 5%, and then interest rates can get above that and do it the rest of the way. But it's strange. I think we're getting a bit Mystic Meggy here, and it's really not the way either of us invest. It's just interesting and not interesting in the same vein, I think.
Yeah, I think the way I think about this, and I think you're probably similar, is look, we're not going to buy things based on the idea that CPI is this number or that number or whatever. But macroeconomic features, insofar as they're really glaringly obvious, and we'll tell you about what other people are doing, they give you places that you might want to look at any particular moment. So if you think there's a recession coming, and a lot of people think there is a recession coming, chances are utilities are going to be kind of expensive because people know they go quite well in recessions and so on and so forth. So yeah, they're a kind of interesting guide to me as to where to look for cheap things. You see commodity prices coming down. It's very difficult not to see the price of Southern copper coming down along with them, which has come down quite a way, and it gets very tempting to just sort of roll things across and into that. But it wouldn't be a case of, look, I'm buying this just because the commodity price is down or something like that. You need a kind of better view on, for one thing, why this business rather than some other business. I mean, macroeconomic features tend to affect classes of businesses, some more than others, sure. But, rising interest rates affect stuff like banks and so on. But then you need a reason why you're going to have a look at JP Morgan rather than Bank of America, rather than Citigroup, rather than anything else. You get the general idea. So yeah, it's an interesting thing, and I think it's worth being aware of. I think there's some sort of value to knowing it, but it's a small part of, I guess, what we think about.